All right, Chapter 8, Classwork 9, Dividend Income. So, if shareholders own a corporation, are they entitled to some of the profits? So you know that if you buy a stock, it's going to go up, it's going to go down. But keep in mind, any gains or losses are not going to be computed until the stock's actually sold. So yes, you can watch the stock go up and you're like, yay, or you can watch it go down and you're like, eh. But it's not a gain or a loss until you actually sell it. But here we're talking about dividends. So your stock portfolio can earn income before you sell your shares. So remember, a shareholder is an owner of a corporation, and as an owner, you're entitled to part of the profit that the corporation makes. So a profit split among shareholders is called a dividend. And of course, money received from dividends is dividend income. Dividends are usually paid annually or quarterly, and the board of directors sets the dividend for one share of stock. So they say, okay, we're going to pay, 13 cents per share. We're going to pay $1.37 per share. For major public corporations, this information can be found. It's public knowledge under a column headed Div in the stock table. Your total dividend is going to depend on the number of shares you own. Some corporations don't pay a dividend because the profit is being used to improve or grow the company. Some corporations do not pay a dividend because they have no profit. So a stock that pays a dividend, we call those income stocks because it provides their owners with income. And this is really important to say, like retired folks. It's another way that they can have a source of income. Some people buy income stocks which pay dividends, and the yield, and we're going to do a lot of yield today, the yield of a stock is the percentage value of the dividend compared to the current price. And investors use the yield to compare their dividend income to the interest they could have made if they put the money in the bank instead of buying the stock. Other investors are not concerned with dividend income. They want to buy low, sell high. A stock that is bought for this reason, we call a growth stock. And you can be both an income and a growth stock all at the same time. Stock is also classified, and this is something that you want to pay attention in your adult life, preferred stock or common stock. Preferred stockholders receive their dividends before common stockholders do, and they usually receive a set dividend that does not frequently change. Common stockholders receive dividends only when the board of directors elects to issue these dividends. So you might have the stock and it might pay the preferred people, but it might not pay you. Additionally, if a company goes out of business, preferred stockholders are entitled to assets and earnings of the company ahead of common stockholders. Dividend payments are usually mailed to stockholders or electronically transferred to their accounts. There we go. Dividend payments can range in value from a few cents to thousands of dollars, depending on how much the dividend is and how many shares are owned. And they're not guaranteed, and they could be cut or eliminated if the company decides they need the money. But most companies don't like to do that. If your stock pays a dividend, you want to make sure that the money amount you're receiving is correct. Yada, 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 yada. Here we go. On to example 1. So Roberta's considering purchasing a common stock that pays an annual dividend of $2.13 per share. If she purchases 700 shares for $45.16, what would her, these are the things you have to do, annotate your question, quarterly income be? So income from dividends equals number of shares dividend per share. So in her case, it's 700 shares times that $45.16. That gives her $1,491, except it's paid quarterly. And so we're going to take that 1,491 divide by 4. And so each quarter she's going to get a check for $372.75, which is not bad. And then she'll have to report that on her 1099 div, because she still has to pay taxes on that income. Example 2, Elise owns 2,000 shares of a corporation that pays a quarterly dividend of 51 cents per share. How much should she expect to receive in a year from dividends? So income from dividends equals number of shares times the dividend per share. And that is her 2,000 shares times that 51 cents per quarter times the 4 quarters. So she should expect $4,080 in a year. So what is yield? To find the yield of a stock, write the ratio of the annual dividend per share to the current price of the stock per share and convert to a percentage. Easy enough. So Kristen owns a common stock in Max's Toy Den. The annual dividend is $1.40. The current price is $57.40 per share. What is the yield to the nearest 10%? So yield is at $1.40 out of that $57.40. It's going to give you approximately 0.02439 if you plugged it into the calculator, or about 2.44%. Example 4. 1 share of Beef Company preferred stock pays an annual dividend of $1.20. Today, Beef Company closed at $34.50 with a net change of 50 cents, down from yesterday's closing price. So the previous day, day's close is going to be that $34.50 plus the 50 cents. Because if tomorrow it closed down 50 cents, today it was up 50 cents. So that's going to be $35 per share. So our yield is $1.20. Not today's price, but yesterday's price at 35 gives a yield of 3.43% when I put it in the calculator. Yield's going to change based on closing price. A stock paid an annual dividend of $2.14. The stock split 2 for 1. What's the annual dividend after the split? So that means we have, if it's 2 for 1, we have twice the shares at half the price. So we want to know, what is half of $2.14? That is $1.07 per share. A corporation that was paying a $2.10 annual dividend and the stock went for a 3-for-2 split. What is the new annual dividend? So remember your ratio is going to be 2/3 of that $2.10. That's going to be $1.40. Corporate bonds. Buying stock has its risk and rewards. If you don't want to take a significant risk, you can invest in corporate bonds. A corporate bond is a loan to a corporation. The corporation agrees to pay the bondholder back with interest. And let's highlight a couple of these things. A corporate bond is a loan. The corporation agrees to pay the bondholder back with interest, much like a bank does to customers with money in deposit. Interest is usually paid annually or semi-annually. Usually corporate bonds, they sell them in increments of 1,000 or 5,000. The amount is the face value, and that's the amount paid when the bond matures. So you would not necessarily pay, maybe you'd pay 1,000 for it and then collect interest. Maybe you'd pay less, collect interest, and then when it matures, you'd get that $1,000 or 5,000. So when the bond matures, the bondholder receives the face value from the corporation and the loan to the corporation is over. Bondholders do not share in any profits. They don't own part of the corporation. Investors that buy bonds, you have less risk, but you have potentially less or fewer rewards. Trying to get my pen to work. There we go. The maturity date of a bond is a date in the future when the principal invested will be repaid to the investor. The time to maturity can be a short period or as long as 30 years. Upon maturity, an investor will receive the amount originally invested back from the corporation. Bonds that take longer to mature generally pay a higher interest rate. Bondholders can sell their bonds if they decide not to keep them until the maturity date. Adam bought a $1,000 corporate bond. The bond pays 5.7% interest per year. How much does Adam receive? So with bonds, this is always simple interest. So you have to decide as a consumer, do you want to perhaps get a CD where you know you have compound interest, or do you want to buy a corporate bond that pays simple interest but might have a higher rate as long as you hold on to it? These things are things you'll have to decide later out in your life. So 5.7%, 1,000 is $57 per year. And say Adam holds on to it 11 years. That's 11 times 57. So after 11 years, he'll get in interest $627. Plus he'll get his $1,000 back.